I gotta be honest with you, I feel a little bit strange. Yesterday didn't really feel like getting punched in the nuts like I usually feel after Palantir earnings, which is a very peculiar feeling to be honest, but I can get used to it. Now in this video, I'm gonna do a deep dive, long format of the entire Palantir earnings. Now if you're not into Palantir, this video isn't for you. Skip to the next one, it's okay. Now, if you are into Palantir, we're going to do a deep dive, but without over geeking and over detailing the numbers. I don't want to get lost in the numbers. I want to keep it simple, but deep and detailed. Now, hopefully we can achieve that. And this video is going to be a little bit longer. So sit back, relax, and let's do it. So the first thing I want to mention is what just happened post earnings. Obviously, post earnings, the company had a blast of after hours with the share price spiking. I'm assuming the same thing will continue in the pre-market. It's currently 5 a.m., so I don't really know exactly what's going on in the pre-market. Neither do I care, and I'll explain in a second why. This point is coming, don't worry. Now, what happened yesterday is basically Palantir beat EPS, earnings per share, and it actually hit GAAP, generally accepted accounting principle, profitability. So these two elements basically spike the share price. Basically, this all comes down to one thing, which is Wall Street really loves performance and execution on the financial side. Once you hit EPS, once you actually hit GAAP profitability, you'll get a nice little bonus. That's okay. Now, I wasn't particularly focused on these two things, although I did care. I had a whole list of my own, which I posted on Twitter, and it included 7 items. And I'm going to read all the 7 items to tell you what I was looking at. Number 1, obviously, GAAP profitability. I care about GAAP profitability. I actually want to know that the company is headed in the right direction, but it's only 1 out of 7 item. The second item I was looking at is growth guidance. How much the company is guiding for in the financial year 2023. We're going to talk about that because not all is rosy in that section at all, but more on that later. Number 3 is commercial sector growth. I believe that the growth engine for the company is the commercial sector. So I wanted to see the commercial sector numbers. In this section, we obviously check the mark. No problem at all. Exactly what I wanted to see. Number 4. What's going on with US versus EU? This company has a major Achilles heel as far as almost virtually no business in the EU compared to the US. Did it get better? I want to see the company becoming a little bit more global. Obviously, they're not going to go into China. We know why, but at least in the EU front, with everything that happened with Ukraine, with the whole deglobalization, I expected to see a little bit more out of the EU. Not necessarily got what I was looking for there. Number 5, stock-based compensation reduction. I think we already had the big peak of hiring all the sales force to actually go after the commercial market. I'm expecting to see a little bit of a decline, if not more of a decline in SBC, stock-based comp. We definitely got that. More on that in a second. Number 6, net dollar retention. Very important to me to see that the company isn't losing ground as far as charging existing customers more. I'm talking about that as well. I have a whole section dedicated to that. Again, not all is rosy there. As you can see, I'm not into fluffing this company. I'm not here to basically say that everything was great and you should just go all out. There's plenty of channels that do that. On this channel, you get an objective view, the good and the bad. If you want to be actually a good investor, you have to look at the good and the bad and be able to recognize both. So exactly what we're doing in this video. And of course, number 7, I wanted the company to present the data in a little bit of a more straightforward, transparent manner without all this nonsense like aggregating US business. And of course, they didn't do it, and we had to dig through this bullshit again. Sorry for my language, but it is what it is. It might be a company culture thing as far as presentation. I'm not getting caught up in that too much. Now, talking about the company mindset leads me to the second point. In the company mindset section, I've seen a lot of improvement in these specific earnings. And in fact, the first thing I was impressed with Alex Karp's ability to basically be concise, direct, answer to the point, no philosophical stuff. I think it's a really good change as far as Alex goes. It shows a lot of understanding as far as what the market is looking for from a CEO of a multi-billion-dollar company. And I was actually impressed. I gave him an 8 for his performance, communication skills. I know that's not easy for him, but in fact, he was actually so self-aware that he made a little joke about it, basically saying, well, I want to go on this philosophical tangent, but I know you guys hate it, so I won't. And I thought that was actually pretty brilliant. Now, leaving Alex Karp aside, because this was a nuanced thing, nobody really cares about that, let's talk about the most important thing here. This earnings call was the first time where I actually felt that the company was focused on GAAP profitability just as much as it was focused on growth. In fact, probably even more on GAAP profitability this time than the previous quarter. It shows me that the company is actually speaking in that language that institutional investors are looking for. Institutional investors will not invest in Palantir, at least not in huge amounts, until we see GAAP profitability. And the management finally understands it. It's a sign of maturity. It's a sign of basically them talking the language institutional investors are speaking. Does it mean we have a 60% institutional ownership tomorrow? Probably not. But it definitely seems that the management understands the channel change, the frequency change. They have to talk the language of the institutional investors and actually show they care about GAAP profitability. They can no longer do this. Oh, we only care about growth. Screw profitability. They've done it before, and the market punished them for these statements, so to speak. And this time, they actually dodged the bullet and spoke very to the point. I think that the big move here in the share price, and I mentioned this earlier, was the fact that the company hit for the first time in history GAAP profitability. I mean, that's a huge milestone. It came 2 years early because last time we spoke to Alex Karp, basically he spoke to us, he said 2025. So hitting GAAP profitability 2 years early is very, very strong as far as share price performance, as far as institutional participation. I think that this is a huge milestone for the company. Does it mean we have to start celebrating and getting into euphoria? No, no, no. Price action and euphoria post GAAP profitability is understandable. There's a lot of idiots out there, but you should not be one of them. You have to be objective. Look at the good, look at the bad, and actually assess the company for what it did, not for what you think it might. Basically, getting into this FOMO because of price action right now is a huge mistake. There's plenty of time to buy Palantir shares if you want to do so in the next 2 years. There's no rush. Definitely not in the middle of a FOMO cycle, which I hope we don't get. Now, how I personally handle this, and again, I think psychology is a huge part of being a long-term investor. In fact, I would say a critical part is, look, I didn't get down on myself and I didn't get depressed when the share price was $6. I'm not going to get high right now on this $9 share price or $10 share price just because of price action. It's meaningless to me when it's down to 6. It's meaningless to me when it's up to 10, whatever it may be. I care about long-term success. I think that this is a $30, $40, $50 stock in a few years. That's the only thing I'm focused. I don't care about these price swings, and making any decisions based on that, making any kind of euphoric statements based on that is plain stupidity. You have to stay objective. You have to stay grounded. Don't get distracted by this nonsense. Now, to summarize, before we go deep into the numbers, the earnings were good. They were not brilliant. I think there's a lot of places for improvement. There's a lot of work to be done. There's a lot of weaknesses, but they were definitely better and in the right direction. I think there's way more work to be done here. And talking about that, my main concerns are basically the fact that revenue growth this year was actually not that high, at least compared to last year. Last year, we did 40%. This year, 24%. I mean, that's really a huge decline in acceleration rate. Still growing at 24% is impressive, but given last year at 40% growth, that's a huge concern. And I'll talk about why this is happening. I think I know why this is happening, but let's hold off on that for a second. The other thing which I had a huge issue with is the decline in net dollar retention. Now, net dollar retention is basically how much existing clients are paying you more this year compared to what they paid you last year. Now, a company like Snowflake has an 180% net dollar retention, which is insane. Not that I'm expecting Palantir to hit that, but last year, Palantir had 131% net dollar retention, which is very good. This year, 115% net dollar retention. So they're declining on net dollar retention. Now, this is a huge problem because if you're expecting to hit 30% CAGR, you have to be able to charge your existing customers more every single year. It's 10 times easier to upsell an existing client versus to cold call and recruit a brand new client. So losing net dollar retention ground is a huge concern if they are to hit that 30% CAGR. It's just another thing I'm really concerned about. Another point I'm concerned about, and we'll get to the good parts in a second, but I want to start with the concerns, is the fact that cash from operations is down. Last year, they did $330 million. This year, to 120. It's a huge decline. Operating margin is down from 31% last year, 31% last year to 22% this year. Now, there's a lot of excuses to be made here. Obviously, the company is expanding. There's more low-ticket item sales. There's more freemiums. There's more of recruiting going on. And obviously, that hurts the margins. I get it. But still, I don't expect to see such a huge decline from 31% to 22% on operating margins within a year. That's another huge concern. Now, at this point, having heard all my concerns, you might ask yourself a simple question. Well, Tom, are you still bullish on Palantir with all of these concerns? Yes. In fact, I'm more bullish than ever, and I think the results were good. But I showed you all these concerns to show you that not everything is rosy. A lot of people on social media, on Twitter, are hyping up about the share price. They're overlooking these weaknesses. You have to be aware of them, even as a bullish investor. It's super, super important. I'm not here to fluff the stock. I'm here to give you the facts, good or bad. Now, look, let's move on to what I like about this company, what I like about these earnings, and what I like about it beyond just the GAAP profitability. We have talked about it. Everybody has beaten this topic to death. Let's talk about what I like beyond that. Now, number one, I like the customer growth. Customer growth is up 55% year over year. It's absolutely insane, very impressive. But you still have to remember, we did just mention that the net dollar retention is only 115% this year. It's extremely low compared to last year, 130%. It's way lower than the company like Snowflake, but on its own standalone basis, if I tell you, hey, I have a SaaS, software as a service business, and I'm having 115% net dollar retention, it's not a bad result. It's just not as good as it used to be and not as good as we expected. But getting more clients through the door is the first step of fixing that. So 55% growth in customer count is good. It's also a huge mitigation to the concentration risk. You never want to have too much business in the hands of too little clients. That's a huge risk. Now, talking about that, Palantir's current top 20 clients comprise about 50% of its entire revenue. So 50% of Palantir's entire revenue is sitting in the hands of just 20 clients. That's a huge concentration risk. However, those 20 clients, the best 20 clients of the company, have increased their spend by 13% on average, from $44 to $50 million per client per year in this current year, which is really impressive. I mean, corporate America mainly doesn't spend $50 million a year for a service provider unless they have the good stuff. So the increase from 44 to 50 million per client per year on the top 20 clients shows me their product is that good and even better. Now, the second item I want to talk about is stock-based compensation. That's one of my specific focus points. I'm happy to report that although stock-based compensation is still fairly high, it's down 27% year over year, which is a step in the right direction. Now, the next point I'm really excited about is the deal flow. Palantir increased their deals closed this year by more than 60%, from 600 to 980 deals closed just in the entire year of 2022. That's a huge increase. That shows me that their business development, that their sales force is actually doing its thing, which is what I was concerned about because we didn't know how good these salespeople were. So that's another important milestone we have to be aware of as a positive signal. Now, let's talk about commercial growth. Now, commercial growth is very impressive, 67%, which is something to be celebrated for sure. However, what I'm still missing here is a push on the EU side. Now, the EU side is pretty much non-existent. I love how the growth in the US is absolutely insane, but the EU is still the Achilles heel of this company. We don't have to go to China. There's plenty of business to be had in the EU, and Palantir has to try and diversify a little bit outside the US. Currently, their entire commercial business is primarily in the US, and that's another huge risk. It's concentrated. We have client concentration problems and geographical concentration problems that need to be fixed. But then again, 67% is very impressive. But if you look at the entire commercial growth, it's 29%. That's what happens when you have 0% or close to 0% at other geographies. Now, the one thing I want to talk about is the government. Now, government, it's always been kind of the anchor of this company. A lot of government clients, they're very sticky, but they're actually increasing the government revenue. This was the first year in the company's history they crossed the $1 billion revenue per year from government business. It's insane. It's very, very impressive. However, you have to be aware that the growth is not going to come from government. Government comprises about half of this company's business, give or take, but the growth on the government side is only about 13%. It's a lot slower. It is stickier, but it's a lot slower than the commercial side. It's another thing to be aware of. And I guess the most impressive part about this company is that somehow sales are up 24%. Whether you think this number is high or not, it's still an impressive number on a standalone basis. So sales are up 24%, but sales expenses, SG&A, is down 7%. But at this point, you might say, well, Tom, that's because they're paying everybody with stocks. Well, it's kind of true, but stock-based compensation is also down 27%. So the company is generating 24% more sales, but it's paying less in stock-based comp by 27%, and it's paying less in SG&A by 7%. That's very impressive. And let's talk about the weak guidance we got for next year. Not very impressed by that. 2.2 billion, give or take, based on a year we just finished with 1.9 billion. So it's a very, very cautious guidance, very, very meager. Why? Well, there's two reasons here, there's really three reasons. I hope the third one is not legit. Reason number one, they're just sandbagging it. They're basically giving us low guidance so they can beat it. Definitely possible. They're not the first one to try this method. In fact, they have before, and as you can see in this guidance, it worked for them. Last year, they lowered guidance, and this is what we got this year, a huge spike in the share price. Maybe that's the case. Maybe it's because they think that next year macroeconomically is going to be horrific and they're adjusting to that. Maybe, possibly. Maybe it's a combination of both. I don't know. There is a third reason is because their business is trash. But at this point, I tend to think that this reason is not so valid. But if it is, then that would be a good reason to lower your guidance. Again, I don't know. I'm not a fortune teller. Now, there's two more things to talk about. Very important. I had a lot of questions post-earnings. One question was, when will Palantir be added to the S&P 500? I would say that this question is as ridiculous as asking somebody who is a high school varsity player when he's making it to the NBA All-Star game. I mean, this is way too early to talk about that. That's not even the serious question. The other one, which was a little bit more serious, started by Alex Karp hinting at possible M&A, at possible acquisition. If Palantir will get acquired by a big company, obviously there's going to be a huge spike in the share price and all that good stuff. And I think it's partially responsible for that share run-up we saw. I'm just here to tell you that I think it's highly unlikely that Palantir would ever be a target of an M&A, of a mergers and acquisition activity, for two reasons. Number one, it has a Class F shares, which gives unlimited lifetime veto to Alex Karp and Peter Thiel and a lot of other guys. And the other part is their government business is dependent on them not doing business in China. Any acquisition that you can think of, who would buy Palantir that doesn't have business in China, that doesn't have Chinese exposure, because in that case, all their government side is going to the toilet and they become half as valuable as they are right now. So unless they can find a strategic purchaser that has nothing to do with China, which is very hard in this day and age, I think this is highly unlikely. I think it's a lot of hot smoke air to kind of pump it up a little bit. I don't take this seriously at all. Now, I want you guys to tell me right now in the comment section two things. Number one, what did you think about the earnings? What kind of score do you give it from 1 to 10? I'm curious to hear you. And also, if you can explain to me what is the one thing you love the most, what is the one thing you hated the most, I will pick the most interesting comment or a few for my next video to highlight on my channel. As always, thank you for staying with me. If you haven't yet, there's about 30% of you who's watching who are not yet subscribed. I don't care about the likes and all that stuff or Patreon and all that stuff, but I am really focused on actually growing my channel, getting to 300,000. If you can subscribe to the channel, if you find value in it, I'd really appreciate it. Thank you so much. Even if you don't, just keep watching the video. See you next video.